Corey and Chad here, joining Nick Hodge, co-owner of Digest Publishing and editor of Foundational Profits and Hodge Family Office. Nick covers a wide range of markets in the information he shares with his subscribers. And Nick, it's always great getting you on the show because you have such a wide net that you cast as far as the macro side of things, looking at individual sectors. And then, of course, we always love diving down into the resource stocks and the commodities with you. Let's just out of the gate here, take a look at the macro landscape as we see it today. What are the main things on your radar? What are the main drivers that you think are going to affect either central bank policy or the markets?
Yeah, I think you've got an investment market that hasn't gotten the message yet as far as the Fed being serious about this rate hiking cycle and keeping rates high enough for long enough to get inflation down to 2%. So that's a good place to start. Inflation is nowhere near their 2% target. Yes, it's come down to 3.2%, but not going to come down much further than that. It's going to be sort of pinned higher there in the 3.5% range, I would say, for several months to come. And so that's going to keep the Fed relatively hawkish. And we've seen a lot of talk about, a Fed pivot and they're going to cut in 2024. And that may be true, but I think it's going to be later in 2024 than anyone realizes. And really that call for a pivot and in many cases that need for a pivot from many investors from the Fed hasn't materialized for a year, and it's not going to here. So I think that's the first thing. I think another thing is to talk about is head fakes, right? Because you've had sort of a battle of the bulls and bears when it comes to this S&P for going on 2 years now. And it's interesting because timeframes and lenses matter. So yeah, the S&P is up for the year, but it still remains down from its peak at the beginning of 2022. And so, it hasn't been crashy. It still is in a bear market. And so I don't think the Fed sees any urgency to cut rates. You had a head fake in the summer in the July month, and I think you had that again in November with the 10-year and the 2-year yield coming down, which allowed another rally in equity prices and certainly a rally in gold, which we can talk about in a second. It was one of those scenarios where bad news was good news again because bad jobs reports was going to make the Fed cut sooner than later. And I don't think that's the case. Yeah, we're missing numbers. There was an ADP report out this week that missed, but they're not missing drastically. And we haven't entered the recession yet. Remember, we had over 5% GDP growth in the US in Q3. That's going to start to slow down here again. You'll start seeing recession talk again, I think, in the January timeframe. And so it's more of the same, right? Even though we've had these, months of head fakes that I just outlined there, the trend in the overall equities, I think, is still bearish. A lot of bearish indicators and undertones out there. The last time we all spoke a month ago, I was telling you the things that were reflective of 2007 and 2008 and the global financial crisis. And we continue to see some of that. Like since you and I spoke last, the 10-year did hit 5%, although it's come down a bit. That hadn't happened since 2007. And, now we're seeing the consumer starting to weaken. Everybody sort of knows about this record credit card debt. And we're starting to see that roll over now with delinquencies now mounting more out to 90 days and consumer bankruptcies, by the way, at their highest rate of growth year over year since the global financial crisis. And so the surface is still okay with that S&P, only down marginally, as I've said. And, lots of people also know that was because of, large tech stocks, the so-called Magnificent Seven propping it up. But from where I sit, it's a return to slowing economic growth, relatively high inflation, certainly well above the 2% target for months to come, and sort of a pause, but definitely not a pivot in the Fed rates for the next 3 to 6 months.
So let's tie this all into a discussion on time frames then, Nick, because a lot of what you were talking about there does tie back into Fed expectations and now cuts. The first rate cut predicted in March and then 3 more for the rest of the year. But we heard that all through this year as well. And also looking at the markets, I found it so interesting how markets have moved in a way, almost longer term trends. For 2022, the markets went almost straight down for 3 quarters, and then they rebounded for almost 4 quarters. And now we're about to be turning the calendar over into 2024. And I know that calendar days shouldn't really matter, or the change in a calendar shouldn't really matter for investors. but it seems to have over the last couple of years. So how are you balancing out time frames when you're sharing some investment advice with subscribers?
Yeah, the calendar is not the cycle. And so I guess to get philosophical for a second, one of my messages over the past 2 years has been how you view time in general, right? Cyclical versus linear. And for a long time of human history and development, we viewed time as cyclical, right? We planted in the spring and then we harvest in the fall, or we hunted at certain times because we knew that's when the animals came through. And then, sort of the advent of religion made us think linearly from some sort of Genesis marching linearly forward to some sort of Armageddon. And that's when we really adopted the calendar. It's why, religions have had such a heavy hand in frankly, the adoption of the Gregorian calendar. So the annual year, the calendar year is a march forward. There's a Genesis in January, and there's an end, or a culmination, or an Armageddon in December, a starting point and an end point. But the market cycles, economic cycles, resource cycles, commodity cycles, they don't begin and end in January and December. And so yeah, like you say, time frame matters. And so it is really interesting that the stock market did happen to peak on like the first trading day or week of 2022. But I think that was partially a coincidence. So I guess what I would say is the market is down still from its peak in early 2022. And if you do look at it in cycle time, the cycle, as I was just outlining, is still bearish and one of higher risk than reward, as I see it in the broader indices. And then you have to look at performance through that cyclical lens as well. I've been telling my readers we had a really fantastic 2022, and 2023 we still made money, but we haven't matched the return of the S&P in our long-term, safe retirement accounts, simply because the S&P has had such a great calendar year, up some 20% the last time I checked it. But because we got the cycle right, because we traded the end of 2021 right, we got out of energy before it went down in early 2022. We got out of the S&P. We got out of, things that haven't had a good past 2 years. We had a much better 2022 than certainly the S&P, which was negative. And so over the past 2 years, we've outperformed the broader market. And that's how I've been sort of trying to get at least my readers and members to think about performance and to think about how they think about the market, I guess, as well. And then when you then talk about institutions or Wall Street, they have a mandate and certainly they have bonuses and things that they chase, that they want to match performance of their benchmarks, which if you look at the S&P, as I just said, is up 20%. And that creates some of this, chasing and buying that we've seen and that I outlined, earlier in our talk here, where we've had head fakes in July and November, where stocks went back up. And to some extent, I think that's a long-term function of the zero interest rate policy that we had for a decade, and the fact that it takes a long time to change that behavior. Now, I think it was Shad who was saying that, some investors have never known an environment other than that. And so it takes time to change those behaviors for, bad news to become bad news again, for the market to realize that the Fed is serious. And again, that doesn't necessarily happen on a January to December timeframe.
Nick, some very cogent points there for people to consider. And just along this same line of thinking, we heard from a lot of people that 2022 was a bear market in many markets, and it absolutely was. But just going back to this calendar year, I think you're spot on. A lot of Wall Street or Bay Street is incentivized based on quarterly benchmarks. So everything for them is based on how the first quarter, second quarter, third quarter, fourth quarter goes. But the reality is the markets are completely oblivious to what the calendar is, and they're moving on different cycles. The actual pain started in the markets and the underlying breadth in many of the growth tech stocks and many of the meme stocks and stay-at-home stocks crashing the middle of 2021. We were already in a bear market under the surface. It was just the indexes that were holding things up. So my question is, how do you look at things as far as a market that's kind of divorced from itself? On one level, if you look at the weighted indexes like the S&P and the NASDAQ and U.S. equities, you can get a false signal that everything's hunky-dory because the indexes are making new highs, but that's all concentrated into a small amount of stocks. We were joking off mic that we're into the new Nifty 50 again, like in the 1970s, or it was very much like the tech bubble of the late 90s into moving into 2000, where everything's concentrated into a few names. It can give false signals. But when you look under the market breadth at the overall market, it's not up nearly so much. In fact, a lot of stocks are down on the year. And same thing with earnings. A lot of earnings are actually in the negative when you look at the large market breadth. So how do you balance that out, Nick? The overall market direction versus maybe the signals that indexes give that are weighted?
Yeah, so I have the chart right here because I put it in my monthly issue. So the equal weight S&P is up 6.5% for the year. The S&P is up 20% for the year, as I've mentioned already. And those top 50 stocks are up 33% for the year. So the 50 largest stocks in the S&P are up 50% more than the 500 that are in the total index. And obviously that's a function of weighting, where the higher market cap companies get a larger weighting in the index. And so you're getting to a place now where, as you say, the breadth has narrowed, right? Even the Magnificent Seven aren't the Magnificent Seven anymore. Meta hasn't been performing as well as it was, and so it's down to the Magnificent Five, perhaps. And the analogy I've been making is you're getting more and more chairs taking away at the dance, the game when the music stops, right? So there's not that many chairs left, and you can think of it sort of as ice breaking or a sinkhole where you can't see necessarily what's going on under the surface, and then all of a sudden the entire surface caves in the case of a sinkhole, right? And so you do have to sort of pull back that curtain and look underneath. And I mentioned some of those things already, right? The consumer bankruptcies and some of the things that were analogous to 2007 and 2008. But I mean, there's others, Manufacturing again was below 50 on the ISM survey, continues to be contractionary. Look at the rest of the world. I mean, Europe and many Asian countries in clear recession in contraction territory. Retail sales in the US have gone down for 12 consecutive months. And so if you look at these things under the hood, what you're seeing, and what's always been true, is that the stock market is not the economy, right? And the stock market, again, to sound like a broken record, has done well this year, and returns are returns, sure, but underneath the surface, the things that are going to drive the market going forward, right? The consumer spending, the economy expanding, inflation coming down, or being able to be outpaced at least by growth. Those things are not happening, right? And at some point, we're going to get this other recession. And oh, by the way, the yield curve, which I don't hear people talking about anymore, is still inverted. And anytime it gets close to going to zero or positive, it shies away from that. So in a very real way, these indicators or themes or whatever you want to call them that forecast or prognosticate very accurately that all is not well, are telling you that all is not well. And so we know that the Fed wants that, and at some point that's going to materialize and become the catalyst for a turnaround in rates. But again, not for the next, I don't believe, 3 to 6 to 9 months. So I'm not sure that answers your question about breadth, but I think the ice or the sinkhole analogy is a good one, where you can't see, at least on the market surface, which is the S&P, what's going on with all these things under the hood that eventually are going to materialize in the market.
All right, Nick, let's start talking some individual sectors, and let's start off with the precious metals. I think we all know, our listeners follow the precious metals closely, and look, gold is over 2,000, even poked its head over 2,100, and we have seen some life in the stock. Something like GDX has been up 18% in about 14 days. It's up 24% since the breakdown in early October. Now, if you look at a longer term chart, there's still a lot of upward moves to just take back a lot of those losses over the last about 3 years. But from a momentum side, again, GDX, do you think that the momentum has switched, the trend has switched to more bullish?
For sure. A monthly close above 2,000, which is something I told you was needed for, generalist or retail investors to get more interested in the gold space. We got that at the end of November. That was partly due to, at least the narrative was, gold is now pricing in rate cuts, which we've talked about a lot on this interview. And that allowed gold to rocket to 2,100. And now, the reality that I just laid out for you, I think, is starting to set into the market that, maybe rates aren't going to get cut as soon as once thought, or as fast as people thought. And so you've had gold pull back now, right, to just above 2,000. Technically, it looks good. I think if it holds 2010, you got a real shot at staying above 2,000 here. We'll see what the Fed chair has to say at the meeting next week. I'm keenly interested in what he has to say. But no, look, the indices turned, both the GDX and the GDXJ. Last month, I told you that producers were able to make money, and one of the reasons I invested in producers is because, unlike exploration plays, is that you could analyze balance sheets and production results and financial results and get some sort of clarity and forward guidance, as opposed to the opaqueness of the explorers, where you're just waiting for results from a drill core. And I mentioned specifically Fortuna a month ago when we talked. That stock is up 26% over the past month, and so they are starting to turn. They are starting to attract attention. The trees don't grow to the sky, I always say, and so I do expect consolidation. But nonetheless, I think you're going to start seeing more of a rotation into gold stocks as people realize that it's in a bull market, right? Given that it was an all-time record high for gold price, I didn't see a lot of fanfare around that outside of sort of the mining space or people who are interested in precious metals. I think that changes if gold can hold above 2000, and you're absolutely correct. Still a lot of ground to make up. Look, since 2010, the end of 2009, gold is up something like 86%, and the GDXJ is down 65%. They've been completely divorced, right? And so the clever line I was writing about in one of my issues this week is that they're going to get back together, right? And that reunion is going to be very profitable. Even if the GDXJ doesn't have to rise all the way to where gold is, even if gold comes down a little bit and GDX rises, there's still a lot of money to be made as we revert to some sort of median or some sort of norm here, where the mining equities are reflective of the price of the underlying commodity or currency, in this case of gold. And so, yeah, allocating capital to quality companies, which I've been telling you. I put out a new recommendation on a quality gold speculation this month, and they're still very cheap. I mean, I saw some congratulatory tweets going around, and that's pretty myopic considering how depressed and debased the TSXV is as an exchange, and how far down the GDX and GDXJ are relative to gold over the past 13 or 14 years, as I just outlined. And so a significant opportunity there, contrarian opportunity, I would say, still, even though you've got gold at a record price, because in a historic framework, the equities are still so underpriced.
Well, Nick, just to follow up on that, and it's really more about the sentiment side of things. To your point, there's a big divorce between where the mining stock valuations are and where they've been historically at a lot higher gold and silver prices. And it's astonishing. We've asked people over and over again for the last year or two, or maybe the last 3 years, what's the reasoning? And the same answers come back in every time. The costs have risen. That's true, but the costs haven't risen enough to account for the punishment that the mining stocks have had to the downside. And there's been dilution in the sector, but it still doesn't match the amount when you look at some of the producers or some of the royalty companies. It doesn't match the amount that some of them have fallen off of their highs. But on the junior side of things, it's even worse. Some of those stocks down 80, 90%. And when gold has been making record monthly close last Thursday, record weekly and daily last Friday, there hasn't been that much fanfare even inside the resource sector. So what do you think gets the sentiment really moving again in the sector, where we start to see substantial outperformance of the mining stocks over the metals for extended periods of time, and where the juniors finally get some lift, where that rising tide finally does lift all boats?
Yeah, I think it has something to do with market psychology and bad news becoming bad news again. And so I'm talking through this in real time with you, right? So one, gold had some geopolitical catalysts, right? We had a war in Russia and Ukraine. We had Hamas and Israel, and that sort of started the pot boiling a little bit. Then we had a soft November for rates, as we've discussed on this call, potentially a head fake, where rates come down and allow equities to go back up. And in this case, gold is starting to sniff out coming rate cuts in 2024. So what's next? Like, what's the next catalyst for gold? We just had the geopolitics, which is a flash. That's not a sustainable driver of gold. We had the rates coming down in the dollar softening in November, but we think that That's not sustainable because we think that the rates are going to get, pinned higher here and not cut for the next 3 to 6 months. And so what is it that's going to keep gold above 2000 and in turn attract investors to the space? It's an important question, and it's one that's very tough to answer. You just said it's been tough to answer for years. I think the answer I'm going to give you today is the reality of bad news becoming bad news again, right? So if we've checked off those boxes, the geopolitics and the rates and the dollar, what you have next is a fundamental fear driving of gold. And that's going to materialize, I think, as the economic reality starts to get reported with additional erosion of the jobs market, a return to a softening of growth in terms of U.S. GDP, and the data continuing to report this U.S. consumer that I believe is running on fumes here. And so if that's a cascade, if you will, of different reasons and catalysts for gold to march higher and stay higher, and then in turn attract capital and investors, I would think it's morphing into the fear trade now after we've had the geopolitical catalyst and the rate and dollar catalysts.
Now let's carry over the potentially some of that economic weakness or just generally weaker data to some of the other commodities, because copper ran up to almost $4 and then has pretty quickly reversed over the last couple of days. And energy, oil, has continued to move down, now under $70. Natural gas has also moved down. Does this just tie into that overall, everyone assuming economic weakness is going to take hold, so some of these commodities just continue to sell off in your eyes?
For sure. And we've had this discussion over the past couple of months in these talks, and I've been writing about it for a couple of months as well. We actually narrated it in real time because over the summer I was saying that energy was bullish, and then the last couple of times we talked starting in October, I was telling you it was bifurcating and that those high oil prices could be what begets the next recession. I was saying that, we haven't had a recession without high oil prices preceding it in recent history. And then oil prices started to break down. I was telling you last time we talked, they were at, I think, $75 or $76 a barrel. And today they're at $70 a barrel. And yeah, copper can't get out of bed. It's wedging down and to the right. And every time it gets to the top line of the wedge, it just shies away. And then you mentioned natural gas, and there's other things that have been soft as well. Like corn can't catch a bit either on the soft side of the commodity spectrum. And yet, to go back to our talk about cycles and lenses and time frames, I still believe we're in a commodity supercycle, right? You're just getting a pullback within it, similar as you had in sort of the 2000 time frame, the dot-com crash, and we were still clearly in a commodity supercycle that went until 2008. But the surrounding economic conditions and fear drove down the price of commodities in the 99 to 2001 time frame, despite them being in an overall bullish the super cycle. And so, yeah, that's what copper sees. That's why it can't get above $4. That's why oil has been soft of late for sure. Yeah, 100% accurate.
Well, I think that's a good place to wrap it up. It does kind of tie the conversation together to cycles, to time frames, to widening the lens back and looking at how commodities move. It's a very cyclical sector to begin with, and sometimes it's learning to ride those waves and looking for the time periods where a certain commodity, they don't all travel together either, where a certain commodity is going to have its run and then getting out of position when it's made its run. And so you've done a great job of calling the markets, Nick. It's always great having you on the show just to get your headspace around what's going on in the resource sector and the broader markets at large. And if people like getting Nick's thoughts, definitely click on the link below. It takes you over to Digest Publishing, where you can take a look at their offerings. And Nick, as always, looking forward to our next conversation.
Well, I'll leave you with a Munger quote since we just lost him. And one of them was, the big money is not in the buying and the selling, but in the waiting. And so, if you can separate the signal from the noise, have conviction in your thesis and be patient with your positions, then when things do turn in these cyclical sectors, there's lots of money to be made.